The Phantom Collapse. Look, I need to show you something that happened a few hours ago. While the financial media was covering the usual noise, stock tickers, celebrity CEO interviews, the predictable market cheerleading, something seismic occurred in the Japanese bond market. And I mean genuinely seismic. The kind of event that doesn't make headlines until it's far too late to position for what comes next. It's January 20th, 2026. This afternoon, while most people were finishing lunch or scrolling through their phones, the Japanese government bond market, the absolute bedrock of global liquidity, the foundation upon which trillions of dollars of leverage is built, effectively ceased to function as a rational market. Now, I've been analyzing commodities and stacking physical silver for 12 years. I've seen flash crashes, I've watched central banks intervene, I've witnessed coordinated policy responses that temporarily patched over structural cracks. But what I observed in the data this afternoon is different. This isn't a correction. This isn't volatility. This isn't a technical glitch that gets smoothed out by the next trading session. The mainstream narrative will call this a market adjustment. They'll trot out analysts who reassure you that bond yields are normalizing, or that this is healthy price discovery. They want you to believe this is just another day in the markets, maybe a bit bumpy, nothing to see here. But here's the reality they're not discussing. We are watching the beginning stages of a G7 fiat currency supernova. The Japanese bond market just blinked. And when the third largest economy in the world loses control of its debt markets, the ripple effects don't stay contained to Tokyo. The screens are lying to you. The talking heads are either ignorant or complicit. But the yields are telling the truth, and they're screaming. And here's the piece that absolutely nobody in the mainstream is connecting yet. What Japan is about to be forced to do to the US Treasury market to save itself, and why that move just sent silver vertical toward levels we haven't seen in modern history. Stay with me. This gets deep. Here's my core claim, and I'm going to spend the rest of this broadcast proving it to you with data, historical patterns, and the actual mechanisms at play. The bond vigilantes have returned. Japan has lost control of its debt spiral. And the resulting liquidity doom loop that's now accelerating is catapulting silver toward $100 per ounce. Let me explain the narrative spine here, because this is where everything connects. Japan is the number one foreign holder of U.S. debt. They own approximately $1.2 trillion in U.S. treasuries. That's not an insignificant position. That's a cornerstone of the global financial architecture. Right now, as their own bond market is imploding, Japan faces an impossible choice. They're being forced into a corner where they must sell what has historically been considered unsellable just to survive their own debt crisis. Think about the game theory here. If you're Japan and your 30-year bonds are exploding in yield, meaning their prices are cratering, you face immediate liquidity needs. You have pension funds, insurance companies, banks, all sitting on massive unrealized losses. You have a government that just promised unfunded tax cuts heading into February elections. You have interest expenses that are about to exceed your entire tax revenue base. Where do you get the cash? You sell your foreign reserves, and your biggest, most liquid foreign reserve asset is U.S. treasuries. But here's the trap. If Japan starts dumping U.S. treasuries to fund their own crisis, that pushes U.S. yields higher. Higher U.S. yields make Japan's problem worse because it validates the global sell-off in sovereign debt. It creates a contagion feedback loop. And in that chaos, hard assets, particularly silver, become the only rational escape valve for capital that's fleeing the entire sovereign debt complex. So here's my promise to you for this broadcast. I'm going to walk you through the terrifying VAR shock mechanism that is forcing billions of dollars out of bond positions regardless of fundamentals. I'm going to run the actual stress test mathematics on Japan's insolvency timeline. And I'm going to share my personal battle plan for how I'm positioning around the silver breakout toward $100. This isn't speculation. This is pattern recognition based on 12 years of watching how broken systems finally break. Let me give you the snapshot of exactly what the market looked like this afternoon at 2 p.m. Eastern Time. The Japanese 30-year bond yield hit 3.906%. That's an explosion of 8.44% in yield. For context, sovereign bond yields don't move 8% in a session unless something structural is breaking. The Japanese 40-year bond yield reached 4.22%. This is a historic high. We have never seen Japanese 40-year yields at this level, ever. Not in the deflationary decades of the 1990s and 2000s, not during any previous crisis. This is uncharted territory. The Japanese 10-year yield climbed to 2.37%. That's the highest level since the 1990s. For a country that has spent the last 30 years fighting deflation with zero and negative interest rate policies, this is a complete regime change. Now, the contagion didn't stay in Japan. The U.S. 10-year Treasury yield climbed to 4.30%. The U.S. 30-year Treasury is now knocking on the door of 5%, currently sitting at 4.93%. When the 30-year crosses 5%, and I believe it will, That's a psychological and technical break that will accelerate institutional selling. And here's where it gets interesting for those of us watching the metals markets. Gold is currently trading at $4,759.50 per ounce. Silver hit $94.52. And I was watching the intraday action. Silver tested the $95 level during the session. Now, I want you to understand the contrast here because this is critical. The paper price of silver, the futures contracts, the digital IOUs traded on the COMEX, is showing this massive rally. But the physical reality in the vaults, in the actual delivery markets, tells an even more dramatic story. Physical silver is disappearing. The premium spreads between paper and physical are widening. Dealers are running low on inventory. So while bond prices are collapsing, physical metal is being pulled from the market by buyers who understand what's happening. And here's the other data point that confirms the structural break. The Japanese 20-year JGB auction that occurred recently saw a total demand collapse. The bid-to-cover ratio cratered. Investors are literally refusing to buy Japanese government debt at these yields, which should theoretically be attractive if you believe in the stability of the issuer. They don't believe. The market is voting with its feet. So investors are fleeing what have been considered the world's safest assets, sovereign debt from G7 nations. They're running from bonds. But where they're running to next is a trap that most people won't see until it's far too late. Because if you flee bonds and chase equities or corporate debt or anything else built on the assumption of continued cheap financing, you're just moving from one cabin to another on a sinking ship. The mechanism: understanding VAR shock. All right, let's pull this apart. Because the key to understanding why this isn't just another volatile day is understanding the mechanism that's driving the forced selling. It's called a VAR shock, a value at risk shock. I'm going to explain this as simply as I can, because once you understand this, the rest of the crisis becomes inevitable. VAR is a risk management tool that every major bank, every institutional investor, every pension fund uses to monitor their portfolio exposure. It's essentially an algorithm that says, based on historical volatility patterns, what's the maximum amount of money we could lose in a worst-case scenario? When markets are calm and volatility is low, VAR models allow institutions to hold large positions with relatively little capital set aside for risk. The algorithm says, history shows that bonds don't move much, so you can lever up and hold more bonds per dollar of capital. But here's the trap. When volatility suddenly spikes, when yields start moving 8% in a session instead of 8 basis points, the VAR model immediately recalculates, and it says, wait, the risk just exploded. You need to either post massive additional capital, or you need to sell positions to get back within your risk limits. And since most institutions don't have unlimited capital sitting around to post as additional margin, they sell immediately, regardless of price, regardless of fundamentals. It's not a choice. It's a mathematical requirement to stay within their risk parameters. Here's the analogy I use. Imagine a nightclub with a strict capacity limit. The fire marshal says the building can hold 500 people safely. On a normal night, 400 people are inside, everything's fine, everyone's having a good time. Then a small fire starts in the kitchen. It's not huge, but people notice. A few people head for the exit, then a few more. Then someone yells, "Fire!" And suddenly everyone rushes for the door at once. Now the capacity limit itself, the rule designed to keep people safe, becomes the thing that causes the crush. Because everyone is trying to exit through the same door at the same time, and the safety limit makes it impossible for the people still inside to get out. The exit becomes a bottleneck. The safety mechanism becomes the source of danger. That's a VAR shock. The risk management system designed to protect institutions during volatility becomes the thing that amplifies the volatility. Selling triggers more volatility, which triggers more VAR breaches, which triggers more forced selling. And right now, Japanese government bonds are trading like meme coins. The volatility is so extreme that it's breaking the risk models. Every major institution with JGB exposure is hitting VAR limits simultaneously. And they're all trying to exit through the same door. Stop. Look at this pattern. If you chart the Japanese 40-year yield over the last 20 years, you see a relatively stable, slow-moving line. It barely fluctuates. It's the definition of safe in quantitative models. Then, suddenly, in recent sessions, it goes vertical. That vertical move is what breaks the VAR models. Because the historical data says this doesn't happen, but it's happening right now. The institutions aren't choosing to sell because they think Japanese bonds are a bad long-term investment. They're being forced to sell because their risk computers are screaming at them that they're overexposed. It's mechanical, it's algorithmic, it's unavoidable. And once this feedback loop starts, it doesn't stop until either the central bank steps in with overwhelming force or the market finds a new, much lower equilibrium price, which means much higher yields. Now let's run the numbers because this is where theory meets brutal reality. I'm going to give you two scenarios. A conservative one. and the stress test that I believe is closer to what's actually going to happen. Conservative scenario. Let's assume the Japanese 30-year yield stabilizes below 4%. Maybe it peaks at 3.9, 3.95, and then the Bank of Japan intervenes, buys some bonds, calms the market down temporarily. In this scenario, Japan might be able to limp through the February elections without a full-blown crisis. They'd have to drastically cut spending. They'd have to abandon Prime Minister Takaichi's unfunded tax cut promises. They'd have to implement austerity that would be politically toxic. But mathematically, if yields stay below 4%, they could theoretically survive in the short term. Now, the stress test scenario, which is what I believe we're actually heading toward. If the Japanese 30-year yield stays at or above 4%, which is where it was this afternoon, the interest expense on Japan's national debt becomes functionally unpayable. Let me break down the math. Japan's national debt is approximately 250% of GDP. That's around $10 trillion in total debt. If the average yield on that debt rises to 4%, the annual interest expense is $400 billion. Japan's total tax revenue in a normal year is roughly $550 billion. So if interest rates stay at 4% across the curve, the interest expense alone would consume nearly 73% of all tax revenue. That leaves $150 billion for everything else. Defense, healthcare, pensions, infrastructure, government operations, everything. It doesn't work. The math doesn't work. But here's where it gets worse. Prime Minister Takaichi just promised significant tax cuts to win the February elections. Those tax cuts, if implemented, would reduce government revenue by an estimated $50 to $70 billion annually. So now you're looking at interest expenses that would consume close to 90% of tax revenue. And I haven't even factored in the rolling over of existing debt. Japan has to constantly refinance maturing bonds. If the market is refusing to buy new issuance at 4% yields, which is what we saw in the failed 20-year auction, then where does the funding come from? The Bank of Japan could print yen and buy the bonds directly. But we'll get to why that option is also a trap in a moment. Here's the gap that nobody in the government wants to acknowledge. The market is saying no. The bond auctions are failing. International investors are walking away. Domestic institutions are hitting VAR limits and selling. The government is making promises it cannot possibly fund. The math is final. This isn't a political opinion. This isn't a forecast based on sentiment. This is arithmetic. Let me do a checkpoint here because we're about 60% through the core argument. Here's what we know. Japanese government bond yields are at historic highs. The 40-year yield has never been this high. The 20-year bond auction failed. Demand collapsed. The VAR shock mechanism is forcing institutions into a mechanical selling frenzy regardless of their long-term outlook. The mathematics of Japan's debt service are approaching impossibility if yields stay at current levels. Now, I want to look at the only release valve left in this system, and it's the one that connects directly to why silver is exploding higher. Dismantling the skeptics. Before I show you what happens next, I need to address the counter-arguments. Because if you're watching this and you've been paying attention to mainstream financial analysis, you've probably heard some version of the following. Skeptic argument. Number one, the Bank of Japan will just print more money and buy the bonds like they always do. They have unlimited yen. This is a non-issue. Let me explain why that argument is wrong. Or more specifically, why it's a false choice that leads to an even worse outcome. Yes, the Bank of Japan can theoretically print unlimited yen. That's technically true. They have a sovereign currency, they can create it at will, but let's think through what happens if they actually do that right now. We're not in the 2010s anymore. The global context has changed. President Trump is currently threatening massive tariffs. The trade war rhetoric around Greenland and other geopolitical flashpoints is heating up. The U.S. is explicitly trying to reshore manufacturing and reduce reliance on foreign supply chains. If the Bank of Japan announces unlimited quantitative easing right now, if they start printing yen to buy their own bonds in massive quantities, what happens to the yen exchange rate? It collapses immediately. You'd see the yen devalue against the dollar, against the euro, against every major currency. And that creates a different crisis. Japan is a massive importer of energy, of food, of raw materials. If the yen hyperinflates, the cost of those imports skyrockets. You get imported inflation, you get a cost of living crisis for Japanese citizens, you get political instability that makes the current situation look tame. So Japan is trapped between two bad options. Let bond yields explode and face debt insolvency, or print money to suppress yields and face currency collapse and hyperinflation. There is no just print money solution that doesn't create an equally catastrophic problem. That's the doom loop. That's why this is different from previous interventions. Now, let me myth bust another common argument. Higher yields are good for savers. This is actually healthy. In a normal economy with manageable debt levels, Sure, higher yields reward savers and help allocate capital efficiently. But we're not in a normal economy. We're in a debt-saturated system where every major institution is leveraged based on the assumption of low rates. When you're a bank holding trillions of dollars in bonds that you purchased at low yields and suddenly yields spike, the value of your bond holdings craters. You're sitting on massive unrealized losses. If those losses become realized, if you're forced to sell due to VAR limits or liquidity needs, you're insolvent. Higher yields in a debt-saturated system aren't healthy. They're a death sentence for the institutions holding that debt. And when those institutions start failing, you get contagion, you get credit freezes, you get a full-blown financial crisis. So no, this isn't healthy price discovery. This is the end game of a 40-year debt supercycle. All right, now let's talk about what I expect to see in the coming days and weeks. The institutional reaction to silver's rally toward $100 is going to be aggressive. We've seen this playbook before, and they're going to run it again. Expect massive hikes in silver margin requirements on the futures exchanges. The COMEX and other exchanges will raise the amount of capital required to hold a silver contract, ostensibly to ensure market stability, but really to slow down the buying pressure and shake out leveraged long positions. Watch for technical glitches on major trading platforms. I'm not saying these are coordinated, but it's remarkable how often retail platforms experience outages during major price moves. If silver is spiking $5 or $10 in a session, don't be surprised if you have trouble executing trades. You'll see mainstream financial media trot out analysts who explain why silver is overbought or why the rally can't continue. They'll focus on technical indicators, on RSI levels, on moving averages. They'll ignore the fundamental driver, which is the collapse of confidence in sovereign debt. But here's what I'm watching. These are the indicators that will tell me whether this breakdown accelerates or temporarily stabilizes. The dashboard. Number 1, the 4.0% handle on the Japanese 30-year yield. If it crosses 4 and stays above 4 for multiple sessions, that's the confirmation that the debt trap has snapped shut. That's when Japan runs out of options. Number 2, the US 30-year Treasury hitting 5.0%. That's a psychological level that will trigger even more institutional selling. Once the 30-year crosses 5, the narrative shifts from bond volatility to bond crisis. Number 3, silver breaking $100 per ounce on the spot price. That's the level where the short squeeze dynamics become unavoidable. There are massive short positions in silver from bullion banks that have been suppressing the price for years. If silver crosses 100, those positions are underwater and they'll have to cover. Here's the scenario I'm watching for. If these 3 triggers hit simultaneously, Japanese 30-year above 4, US 30-year above 5, silver above 100, the orderly exit from sovereign debt becomes a total rout. At that point, you're not looking at a correction. You're looking at a wholesale repricing of risk across the entire global financial system. Central banks will intervene. They have to. But the question is whether their interventions are still credible or whether the market has lost faith in their ability to control the situation. My approach, behind the scenes. Look, I need to be clear about something. I'm not a financial advisor. I'm not telling you what to do with your money. I'm a passenger on this ship, just like you. But I've been navigating these markets for 12 years, and I've developed a framework for how I personally respond to these kinds of situations. So here's exactly what I'm watching for my own portfolio. You can take it or leave it, but I want to be transparent about my process. Trigger A. If the Japanese 30-year yield hits 4.0% and stays there, meaning it closes above 4 for 2 consecutive sessions, I'm looking to increase my physical silver position by another 5% of my total metals allocation. To me, that's the confirmation that the debt trap has snapped shut. That's the signal that Japan is out of viable options, and they're going to be forced to either print currency or dump treasuries. Either path leads to the same outcome, a flight from paper assets into hard assets. Now, I'm specifically talking about physical silver, not SLV, not futures contracts, not mining stocks. Physical metal that I can hold, that's outside the financial system, that doesn't have counterparty risk. Because here's what I've learned over 12 years. In a real crisis, the paper claims on silver become worth less than the physical metal. The COMEX is a fractional reserve system. There are far more paper ounces traded than physical ounces that exist. When the music stops, you want to be holding the real thing. Trigger B. If the Bank of Japan announces unlimited bond buying, or return to massive quantitative easing, I'm sitting on my hands. I'm not buying, I'm not selling, I'm waiting. Why? Because that move will cause a sawtooth volatility spike that wipes out leveraged positions. You'll see silver potentially spike on the initial news, then crash as the yen collapses and carry trades unwind, then rally again as the currency debasement narrative takes hold. That kind of volatility is deadly if you're trading on margin or trying to time short-term moves. But if you're holding physical metal with no leverage, you can ride through it. My experience has taught me that the big moves happen when you are patient, not when you're chasing every headline. Now, stop for a second. Look at this pattern. If you chart the silver to gold ratio against the collapsing bond prices, you see silver outperforming. Silver is rising faster than gold on a percentage basis. That tells me that investors aren't just buying metals as a safe haven, they're buying silver specifically as a leverage play on monetary chaos. Gold is the safe haven. Silver is the speculation that the system is breaking. And right now, silver is screaming that message louder than gold. Here's my personal plan for if silver crosses $100. I'm not buying at that level. I'm holding what I have, and I'm watching the bond vigilantes finish the job. Why not buy? Because once silver crosses 100, I expect a massive short squeeze. The commercials, the bullion banks that have been short silver for years, are going to scramble to cover. That could push silver to 120, 130, maybe higher in a short period of time. But short squeezes are violent and unpredictable. They can reverse just as quickly as they escalate. If I'm chasing the price at 100, I might end up buying at 120, right before a 30% correction back to 90. So my strategy is build the position now, while silver is in the 90s, hold through 100. And if it squeezes to 120 or beyond, I'm taking some profits on a portion of my stack, maybe 10 or 15%, and waiting for the next entry point. That's not trading advice. That's just how I'm personally thinking about risk management in an unprecedented situation. And look, I'll be honest, there's a part of me that wonders if I'm being too conservative. Because if this really is the beginning of a G7 currency collapse, if we really are watching the debt-based fiat system implode, then silver at 100 might look cheap in 6 months. But I've also seen enough volatility to know that nothing goes straight up. Even in a bull market, there are corrections that shake people out. I'd rather hold a core position through the noise than try to perfectly time every swing. The geopolitical wild card. Now, there's another dimension to this that we haven't fully explored yet, and it's geopolitical. The trade war tensions are escalating. President Trump's rhetoric around Greenland, around tariffs, around reshoring manufacturing, this isn't just noise. This is a fundamental reshaping of the global trade system that's been in place since the end of World War II. And here's why that matters for the bond crisis. The entire post-war order has been built on the assumption that the U.S. provides security guarantees to allies like Japan and Europe. And in exchange, those allies hold U.S. treasuries and support the dollar as the global reserve currency. It's been a stable equilibrium for 70 years. The U.S. gets to print the reserve currency and run deficits, and allies get protection and access to U.S. markets. But if Trump is serious about unwinding that arrangement, if he's demanding that allies pay more for their own defense, if he's threatening tariffs that disrupt trade flows, then the incentive for countries like Japan to keep holding massive amounts of U.S. debt starts to disappear. Why would Japan continue to own $1.2 trillion in treasuries if the U.S. is actively undermining the trade relationship and demanding higher defense payments? The geopolitical tension is the accelerant on the financial crisis. It's the reason Japan might choose to dump treasuries faster than they otherwise would, because the implicit deal that made holding those treasuries attractive is breaking down. And if Japan sells, who's buying? The Federal Reserve? That's just more money printing, more currency debasement, more reason to flee into hard assets. China? They're reducing their treasury holdings, not increasing them. Europe? They have their own debt problems. The bid for U.S. treasuries at these yields is not what it used to be. And that's a structural change that doesn't get solved with a few Fed speeches or a temporary liquidity injection. This is why I keep saying the screen is lying to you. The CNBC narrative about healthy markets and normal volatility is designed to keep you calm while the foundations crack. But the yields are telling the truth. And if you know how to read them, they're screaming. Let me add one more layer to the silver thesis, because this is something that doesn't get enough attention in the mainstream analysis. Silver is unique among precious metals because it has massive industrial demand. It's not just a monetary metal like gold. It's used in solar panels, in electronics, in electric vehicles, and medical applications. Industrial demand for silver is growing, not shrinking. At the same time, silver mining production has been relatively flat for years. We're not discovering massive new silver deposits. The easy ore has already been mined. What's left is lower grade deposits that are more expensive to extract. So you have rising industrial demand, flat supply, and now you're adding a massive surge in investment demand as people flee sovereign debt. The physical market for silver is tight. Dealers are reporting delays in delivery. Premiums for physical coins and bars are widening over the spot price. That tells you that the real market is tighter than the paper price suggests. And here's the thing. The COMEX silver inventories are at levels that are low relative to the open interest in futures contracts. If a significant number of futures holders actually stand for delivery, meaning they demand physical metal instead of rolling their contracts or settling in cash, the exchange doesn't have enough physical silver to deliver, That's the setup for a short squeeze. That's why I think $100 is not the top. It's the beginning of the repricing. Because once the market realizes that there's not enough physical silver to satisfy all the paper claims, the paper price has to rise until it destroys enough demand to bring the market back into balance. And given that industrial users need silver for their manufacturing processes, they can't just stop buying because the price went up. The adjustment is going to come from the investment side. Some leveraged speculators will get shaken out, but the core demand from industrial users and physical stackers like me, that's not going away. The historical parallel. I want to give you a historical parallel because this isn't the first time we've seen a sovereign debt crisis trigger a flight into precious metals. Go back to the late 1970s. The U.S. was dealing with stagflation, oil shocks, a crisis of confidence in the dollar after Nixon ended the gold standard. Inflation was raging, bond yields were spiking, and investors lost faith in the government's ability to manage the economy. What happened to silver? It went from around $4 an ounce in 1979 to over $50 an ounce in 1980. A more than tenfold increase in about a year. Now, I'm not saying we're going to see a tenfold move from current levels. Silver at 94 going to 900 would be, well, it would be the end of the financial system as we know it. But the pattern is instructive. When confidence in sovereign debt collapses, when inflation expectations become unanchored, when people realize that the government cannot actually pay its debts without destroying the currency, they flee into hard assets. And silver, because it's more affordable than gold on a per ounce basis, becomes the vehicle for middle-class investors who want to protect their purchasing power, but can't afford to buy gold by the ounce. There's also a psychological element here that I think matters. When people see silver at $94, there's a narrative that forms, I missed gold at 1,000, I missed gold at 2,000, I missed gold at 4,000, but silver is still only $94. I can still get in. That narrative drives buying pressure. And as silver crosses 100, then 110, then 120, the FOMO intensifies. People who were skeptical start to panic buy. I've seen this dynamic play out in other markets. Once a psychological barrier breaks, whether it's gold at 1,000, Bitcoin at 10,000, whatever, the narrative shifts from it's too expensive to I need to buy before it goes even higher. Silver at 100 is that psychological barrier. And I think once it breaks, the momentum becomes self-reinforcing. Now, let's talk about the central banks, because they're not going to sit idly by while their bond markets collapse. The Bank of Japan will intervene. The Federal Reserve will intervene if the U.S. Treasury market starts to dislocate. The European Central Bank will intervene if the contagion spreads to European sovereign debt. But here's the dilemma they face. Every intervention at this point is currency debasement. If the Bank of Japan prints yen to buy JGBs, they're debasing the yen. If the Federal Reserve launches QE to stabilize Treasury yields, they're debasing the dollar. If the ECB restarts bond purchases, they're debasing the euro. The interventions that worked in 2008, in 2020, they worked because people still had faith in the currency. They believed that central banks would eventually normalize policy, that the money printing was temporary. But we're 15 years past 2008. Interest rates have been at zero or near zero for most of that time. Central bank balance sheets are already bloated with trillions in assets. Government debt to GDP ratios are at peacetime records. There's no more temporary. The market is starting to realize that this is permanent, that the debt can never be repaid, that the only way out is inflation, either explicit inflation through money printing or implicit default through currency debasement. And once that realization sets in, once the faith in fiat currency breaks, you can't put it back together with another round of QE. That's why this feels different. That's why the interventions that worked before might not work this time. The central banks are out of credible tools, and the market is figuring that out. As we head into the rest of this week and into next week, here are the specific things I'm monitoring. First, the Japanese bond auctions. Japan has regular bond auctions to refinance maturing debt. If another auction fails, if the bid-to-cover ratio collapses like it did on the 20-year, that's confirmation that the crisis is accelerating. Second, any statements from the Bank of Japan. If they announce an emergency meeting, if they hint at policy changes, if they try to verbally intervene to calm the market, I'm watching the market's reaction. Do yields actually come down, or does the market ignore them? Third, the U.S. Treasury market. If the U.S. 30-year yield crosses 5%, that's a major technical and psychological break. I expect that to trigger algorithmic selling and potentially force the Fed's hand. Fourth, silver's intraday volatility. If silver is swinging $5 or $10 in a session, that's a sign that the short squeeze dynamics are intensifying. High volatility means the market is repricing rapidly, which usually precedes a major move. Fifth, any geopolitical developments. If Trump announces specific tariffs, if there's a breakdown in trade negotiations, If the Greenland situation escalates, these are catalysts that could accelerate the crisis. And finally, I'm watching the mainstream media narrative. When CNBC and Bloomberg start using the word crisis instead of volatility, when they start having emergency panels with former Fed chairs, when the tone shifts from buying opportunity to risk off, that's when you know the contagion is spreading beyond the bond market. The lag between the actual crisis and the media acknowledging the crisis is usually a few days to a week. So if you're waiting for CNBC to tell you there's a problem, you're already late. The bigger picture, the end of the debt supercycle. Let me zoom out for a moment and put this in the largest possible context. What we're witnessing is potentially the end of a 40-year debt supercycle that began when Paul Volcker broke the back of inflation in the early 1980s. Since then, interest rates have been in a structural decline. Governments and corporations have taken on more and more debt, confident that rates would stay low and refinancing would be easy. The entire global economy has been built on the assumption of cheap credit. Asset prices, stocks, bonds, real estate, have been inflated by decades of falling rates and expanding money supply. But that cycle is ending. Rates can't go any lower. They tried negative rates in Japan and Europe, and it didn't work. It just created zombie companies and misallocated capital. Now, rates are rising. And in a world with record debt levels, rising rates are an existential threat. Japan is the canary in the coal mine. Their debt to GDP ratio is the highest in the developed world. If they can't manage rising rates, no one can. And if Japan's bond market breaks, the contagion spreads. Because the global financial system is interconnected. Japanese banks own European bonds. European banks own US bonds. US pension